everybody, and thank you for joining us for this second edition of our series on our manager oversight and due diligence. I'm happy to be joined by Roland Austrup of WaveFront Management, which sub-advises the Aero Fund, most recently added to our portfolios. So with that, maybe I'll pass it over to Roland and ask him to tell us a little bit about WaveFront and their relationship with Aero.
Thanks, Chris. Yes, WaveFront Global Asset Management is an alternative asset management company based in Toronto. We generally follow very systematic strategies, looking for fundamental sources of return that we think we can rely on to produce returns throughout market cycles. We tend to be first principle thinkers, and we follow a process of observing market behavior, looking at economic theory, behavioral theory, and designing systematic models. We work very closely with some advisors at Princeton in the economics department and in the Master of Quantitative Finance program at the University of Waterloo. The relationship with Aero is a long-term relationship. We have been sub-advisor to WaveFront Global Diversified Investment Class. It's a fund that is on Aero Capital Management's platform. They are the manager of the fund, and we act as sub-advisor for the fund, and it is an 81-102 mutual fund with daily liquidity.
Thank you. And Roland actually just guested in on our investment committee meeting, which we hold every month. And as many of you would be aware, it's very uncertain times economically right now with what's happening with central banks around the world, slight uncertainty in the banking sector here in North America, restart of the Chinese economy. Where we go from here is uncertain. And so when we were looking for additions to the portfolio, we wanted to add something that was differentiated and more uncorrelated to general broad market equities, as you know, the next move could be higher or lower. And that's where we came into this asset class that WaveFront really outperforms in amongst the peer group, and why we decided to add this to our portfolios. So with that, Roland, maybe tell us a little bit about why the strategy you run is different from a traditional, let's call it, stock and bond portfolio.
Sure, Chris. There are a few differences, probably three primary differences. First difference is that we trade a wider range of asset classes than stocks and bonds. In addition to stocks and bonds, we trade global currencies, typically G7 currencies. We also trade commodity markets, so metals and energy markets, as well as agricultural markets, which can include grains and livestock, and those present unique investment opportunities. Another difference is that we can take positions on both sides of the market. So if we are optimistic on a market, we can go long that market, but if we are negative on a market, we can take a position where we anticipate that the prices will come down. So we're not constrained to making money in markets that only go up. The third area that we are different than traditional stock and bond portfolios is that we employ very quantitative strategies across a wide range of asset classes. And that creates a correlation benefit. Typically, our strategies are uncorrelated to stocks, and the correlation is literally about 0.0 all the time. But it does oscillate, and during periods of economic crisis, we tend to become negatively correlated to equities. And the reason for that is because, as I mentioned earlier, we can take positions that take traditional risks and turn them into opportunities. For example, I'll give you two examples. One, in 2008, prior to the launch of the fund on the Aero platform, we were running an OM product. We had positive performance in 2008 because we were able to go long flight to quality assets during the global financial crisis. So long things like the Japanese yen, the US dollar, and bond markets. And we were able to anticipate that commodity prices would struggle, and so we were able to take positions where we benefited from commodity prices decreasing. An opposite or another example, different positions, but last year we had positive performance, not for those same reasons, but because we were able to anticipate rates going up and therefore being able to take short positions in the fixed income market. And as we saw inflation, we were able to take long positions in commodities that profited quite handsomely as commodity prices went up.
As Roland mentioned, the strategy has been around for quite a long time, particularly in the offering memorandum OM space. Fortunately, from the advancements in our industry, we can now have this in a daily liquid mutual fund format, which is fantastic for our clients to get access to this institutional offering. As Roland mentioned, they're non-directional, meaning that whether stocks are going up or down is not overly relevant to the strategy. It tends to do quite well in periods of directions either up or down. As he mentioned, in crises, you can get those positive returns. And part of the reason why we wanted to add this tail hedging strategy to our overall client asset mix to help protect and diversify our portfolios further, adding to that alternative bucket, which, as you all know, is extremely important to us and we really see as the third asset class in traditional portfolio management. And with that, we're super happy to have the fund on the platform and Roland taking this time. So thank you very much for coming in and sharing your thoughts.
Thank you, Chris.